Hey capitalists, what's going on? My name is Kolja and you're watching the Stock Market Nerds. And today I would like to share with you the 5 reasons why I just love passive buy and hold investing. The first reason is because it's just so simple that everyone could basically do it. You don't need an MBA in finance or a PhD in mathematics to invest your money passively. For example, you figure out how much money you have to invest, and then you allocate the capital accordingly to your risk averseness. So you think about, okay, how much money do I want to invest with stocks, which are pretty volatile? How much money do I want to invest in real estate, for example, in real estate trusts? Or how much money do I want to invest in bonds, which don't have that lot of volatility? And then you start doing it without worrying about market timing, market crashes, and all the other stuff. The second reason is because it renders superior returns to almost all other strategies. You know, I just back a couple of days ago I read a study about investors' performance in forex trading in France. I'm gonna link the study in the info section below. And this is also why I love passive investing, because it's research based. There are a lot of guys on YouTube who keep telling you all the stuff about how you get rich and how you turn 10k into 100 million in some time span that's really short usually. But normally those guys, they only make money by selling you expensive products and not by giving you tips on how to yourself invest successfully. So I always tell the story with my buddy, where are the customers' yachts? Yeah. So there's a lot of guys that make a lot of money by selling advice on YouTube or on their websites, but their strategies are seldomly really profound and seldomly really render returns at all. For example, the study I just mentioned found that almost 90% of forex investors, so forex traders that trade CFDs in the forex market, actually don't make any returns at all, but actually lose money. And this is especially important to realize if you want to save for retirement and invest for retirement. So basically, passive investing has shown to render superior results to a lot of normal other strategies, basically because of reason number 3, it's really cost efficient. So basically normal funds have costs up to 1 or 2% per year, and then usually you also, for example, pay a performance fee. Hedge funds basically always have performance fees, but there are also a lot of funds that basically trade a lot, and then you have also the performance fees, and the normal costs are 1 to 2%, or in many cases even more costs. And almost none of these funds beat their benchmarks. So like a normal index ETF on the S&P 500, for example, almost always beats those funds. So it's a lot more scientifically based and a lot more logical to invest in for example, in a Vanguard fund, tend to start trading the whole time. For example, in Germany we have the saying, hin und her macht Taschen leer, which basically means that the more often you trade, the more you empty your own pockets, and your money wanders from your pockets to advisors and funds and so on. So basically, it's not only that ETFs and passive funds are less expensive than more active type of strategies and funds, but also because you don't trade as often and therefore pay less taxes and less fees. So the 4th reason is really important one, and it's one of the basic, most fundamental and most important rules for my own investing, and it's the ROTI, so not the return on investment, it's the return on time invested. So that basically means, okay, how much time does it take for you to render a specific amount of money with your investments? For example, let's say there's some guy who has this really awesome and superior trading strategy, and he manages to get, for example, let's say 9 or 10% per year compounding, and then you are a passive investor and you only make 8% per year, so 10 percentage points less. But let's say because he's trading so actively that he needs to invest 40 hours per week for his strategy, and you only have to invest 1 hour per week for your passive strategy. So this is basically where the ROTI, the return on time invested, comes in, because here you start to compare the returns that you make with the time that it needs for you to manage your portfolio and manage the strategy. And passive buy and hold investing is really time and cost efficient. So you don't need a lot of time. And the last reason why I simply love passive investing is because you can start with small money, and I'm going to show you that at my PC. All right here you can see the S&P 500, the index, which consists of the 500 largest US stocks. And you can also see the MSCI World, which is even a larger index, which is made by MSCI, Morgan Stanley. And what you can see here is that over the long haul, just by investing in this index, you can make a lot of money. And in the meantime, you don't have to start trading. You just keep adding the amount of money which you can invest, either yearly or monthly. It doesn't really matter. And what I do here in Spain and also in Germany, where I used to live, right now I live in Spain. So I have a broker with a Spanish account. I also have a broker in Germany. And what I do is I do a sogenannte Sparplan, which basically is a plan that invests monthly, and the fees I pay are always percentual. That means that, for example, if I invest $200 or 200 euros, then it's 1.5% fees. But if I invest 300 euros or 400 euros or only 20 euros, it's still only 1.5 percentage points. So you can start basically with my broker in Germany, you can start with 25 euros. And I think in USA, basically because you're the most capitalistic country, if I compare it to Germany and other European countries, that there should be a lot of brokers, for example, maybe interactive brokers and other brokers, where you can have a plan where you invest regularly, and then you don't pay high fees. So that's how I do it in my country. And also, of course, this is only a basic video on the general concepts of passive investing. And of course, when I'm gonna make more videos, further we go, we're gonna have a lot of tutorials about the asset allocation, which funds I choose, why I choose them, what are like common pitfalls and all stuff like that. So from now, I just want to show you like a short example. This is a Zinsenberechner, which basically means that that you can figure out the compounding interest of small sums of money or large sums of money. And I just want to show you how powerful this can be, even if you only have small capital. Okay, so let's say you're 25 years old, and that maybe your starting capital, because you saved a little bit and got something for your birthday from your aunt or from your grandmother, let's say your starting capital is 10,000 bucks, okay? It's not a lot of money, but for a lot of people, it actually is quite a substantial sum. So let's say that you start investing $200 per month. I know this is for a lot of students and also for guys in the working place, that's a lot of money. But you know, when I started investing when I was younger, I started at the age of 24, which basically is pretty late considering other people. I have a German YouTube channel where we have a lot of people who start investing when they're 18 or 19, and they start with 20 or 25 or 30 euros per month, and then gradually, as they start to get better education, as they start to get better jobs, they start to invest more. But basically, it's just like fitness, you know? If you start small, then you can gradually increase, but you can't start building your habits when you're 50 or 60 years old. So basically, my current savings rate where I invest in the passive portfolio is actually 400 euros. And next year, I'm going to even increase that. So I increase it year by year. So 200, it's not a lot of money, but I think that everyone who works hard can achieve this, 200 euros. So, and then I just, here, this just means, okay, how often do I save? Once per month, once every quarter, once every half year, or once every year. So I invest 200 per month. And then, this is basically not so important right now. I say, okay, so what's the average return rate of an S&P or passive index fund? It's basically like 7 to 8%, sometimes a little bit more. So let's be a little bit conservative and say, okay, 7% is a realistic goal. And the since period is jährlich, okay, that's also okay. And then here, what we given here is that we don't take any dividends out for our passive portfolio. So here there are a lot of different strategies. For example, Jonathan will tell you a lot about dividend stocks and dividend investing. But here for our passive portfolio, I would suggest you do compounding. So you invest, for example, in ETFs that reinvest their returns from the companies that they invest in. And then I said, okay, so basically you're 25 years old. I just watched a really interesting video from Larry Fink, who's the CEO of BlackRock, who told that basically people always get older and older and older and older. So people who are born right now have a very good chance, like a 20 to 25% chance of getting 100 years old. So if you're 25 right now, your time span for investing is not 20 or 30 years. So maybe it's like 30, 40, or even 50 years, because you can still have your capital working for you when you're 80s or 90 years old. And that's also a really important thing. So, but let's say, okay, you're 25 years old and you're going to invest for 45 years, which would mean that you would stop investing and start taking funds out by the age of 70, okay? And then, yeah, let's figure out taxes. You don't need to pay taxes if you don't take any money out before that. At least that's how it's in Europe. And then let's figure out, okay, how much cash do we have on hand on average? And you can see by the time that you retire, you would almost have $1 million in your account where you can start taking money out. Of course, we have to consider a couple of things. First of all, we have to consider inflation. So let's say you have a return rate of 7% nominal, but the real return rate, for example, is only 5.5 because the average inflation rate is, for example, 1.5% in that year. So let's figure out, you would still have the 900,000 bucks on your account, but they would only have a purchasing power of about 566,000 euros today. But still, imagine that 560 euros is a lot of money, which can increase the quality of your life when you're old by a lot and substantial amount. So, and also consider the fact that you have a little bit more starting capital, or that you increase your investing rate as you go. For example, you get better jobs, you start reading more, you get better payments from your job, or you, for example, you do something on the side, and then you have, for example, you don't have 200 but maybe 300 euros that you can invest or dollars that you can invest. So then, after inflation, you would have 800,000 bucks in your account. So this is the way that you're going to get a millionaire over the long time horizon with investing. Of course, you can get millionaire before, but don't do it with stocks, because normally if you start trading a lot, I just showed you the study, then you will start losing money. Create a business, because you have a lot of time because you invest passively. Okay. So these were my 5 reasons why I love buy and hold and passive investing. I hope you guys enjoyed the video. Let me know in the comment section below, and also you can subscribe to our channel, because from now on we're going to upload 1 video per week, always on Monday. And yeah, let's hear about your strategy, and I'm looking forward to working on these videos, and also to get to know my English, improve my English a little bit, because it's been a long time that I speak English regularly. I read a lot of English books and literature. I watch movies on Netflix in English, and I also went to a German-American school, but I have to get back to speaking English, and it's also good training for me. So, see you guys, have fun, take care.